What I've learned is somebody that does a decent job managing, that's okay. And we just learn where to pick up the slack. So it really ends up being more of this is what they're good at. This is what we can let them do without worrying about it. These are things they're not so good at. So these are the things that we're keeping control of ourselves.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
Hey everybody, welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon, and today we've got Brian Briscoe, founder of Streamline Capital Group, on the podcast. This is a little bit of a longer one, about almost an hour, but we dig in a lot into his kind of journey from being a math master's degree, going into his PhD for math. And then 9/11 happened and he decided to join the Marines, spent 20 years there. But during that 20 years, kind of caught the real estate bug. So we talk about his journey transitioning out of the Marines and into multifamily. And now he is a pretty successful multifamily syndicator. We talk about his area of focus, which is in Salt Lake City, Utah, which is a very interesting market. And so he shares kind of his insights and how he structures deals, which may be a little bit different than some of the traditional syndicators that are out there. So really fascinating episode with Brian. Really enjoy the conversation. So let's get Brian on the pod. All right, Brian, welcome to the podcast. Happy to have you on, man.
Hey, thanks, Justin. Appreciate you having me.
Yeah, no, well, let's kind of jump right in, maybe give the audience a little bit of an overview of who you are, where you are, and kind of what you're up to.
Awesome. Okay, so who I am, let's see, born and raised in the Salt Lake City general area. Just did what everybody did through grade school, high school, whatever. Just tried to get into college and all that fun stuff. Bachelor's and master's degree in math, of all things, from University of Utah, and then started a PhD program. And right now I look back and think, wow, what was I thinking? But started a PhD program in August of 2001. And September 11th was just right after like 3 weeks into the program, and found myself at a recruiter station the day after. So that really was kind of like a turning event in my life, and thought I was going to do like a 3-year tour with the Marine Corps, end up back at grad school, and 3 years turned into 20. Yeah. So just one of those things. I think what I learned by going in the Marine Corps is math wasn't really exciting to me. Every time I started thinking about going back to that life, I was just like, I don't want to. But started picking up real estate along the way. And that was it. It was move every 2 to 3 years. And when we'd move, we'd look at the dynamics and what rent prices were versus mortgage prices. And if we could make things work, turning things into a rental, that's what we did. So really simple prospect. You move somewhere, we look at mortgage prices, we look at rental prices. If rental prices were higher, we'd buy. If the rental prices were lower, we'd rent. And so after 15 or so years, we ended up with 3 properties. Wasn't a ton, but it was enough to get me excited about it. We're seeing income coming in every month. We're seeing debt paid down. We're seeing appreciation. That was really the biggest thing there, is we were seeing the appreciation. And we realized that 3 small down payments had turned into a lot more wealth and equity than payroll contributions to our retirement plans. So it was just like scratching your heads and you're like, this is dumb. Why am I doing this payroll contribution stuff?
Yeah.
And I decided to go all in on real estate. 2018 is when I decided to go all in. At that point, I had 17 years of service. And if you know anything about the military, it's like a light switch retirement plan. As soon as you hit your 20-year mark, the light switch goes on. So I decided to do everything I could during the last 3 years of active duty to learn the multifamily space, to get as many properties as I could, and to never really have to get a job again. And fortunately, I put my mind to it, was pretty successful, found a couple of partners and launched my first real estate company. They still exist without me. I left that company about 1.5 years ago. But long story short, since 2019, I've been a part of roughly 1,700 multifamily units, various roles in different ones. And then about 1 year ago, launched my second company, which is Streamline Capital. And our focus right now is the Salt Lake City metro area.
Got it. Well, thank you for your service. Obviously, 2001 definitely seems like a transition point in your career. You probably were driving down the math PhD. I don't know if you were going to be a professor or some type of math guru. Yeah. very different path post 9/11. So thank you for that. I've actually talked to, I know a few people that have kind of done the military into real estate route. Like they kind of had a similar story to yours where they moved and they were like, well, maybe I'll just hold on to this property and see if I can rent it out. And then you almost became an accidental landlord, right? Mm-hmm. Like you kind of just were like, well, this makes sense financially. Let me just keep it, rent it, and deal with it. With single family, and we'll dig into multifamily here in a second, but with single family, the biggest challenge I see is having that one unit, one tenant. And if that tenant leaves, then you're kind of on the hook for the mortgage and the full bit. So how did you kind of balance that and operating the properties as you were moving all over the country and obviously very busy with being in the Marine Corps?
Well, I mean, we never took money out of the account is kind of what happened. The money was going in and going in. And I mean, we were cash positive most of the time, but you'd have a month or so of vacancy and our account balance would go back down. But the nice thing was, for the most part, the properties were self-sufficient. And I mean, had we been relying on that income, it might have been a little bit different, but I was making enough money to pay bills, live lifestyle, do all that stuff. And so the properties being cash positive, when you had the periods of vacancies, when you had the bigger expenses, I mean, it pretty much just drained those accounts. And every once in a while, we had to throw some money towards the projects. But overall, it was okay. But like I said, the biggest thing that we saw was just how much the values had appreciated. I mean, we bought one house for like $190 and sold it at $3 something. We did sell all of our single family houses when I decided to get into multifamily. But in every case, we were sitting at least $100,000 more in valuation between when we bought and when we sold. And so the cash flow wasn't great, but it was enough that we were able to just maintain everything and keep the lights on.
Yeah. And I think at the end of the day, if your strategy is, and you're not reliant on the income, right? Because you obviously had a job and all of that. So if you can hold it for long enough, obviously the properties tend to appreciate in value, and then you can at least pay down the debt to your point. And that's obviously coming out of the renter's pocket, not your own. And then you can flip it into something bigger, which it sounds like is what you did. So as you were kind of transitioning or kind of thinking about your transition out of the military, you said, I think that was kind of, you went all in kind of multifamily in 2018. How did you pick multifamily? Obviously, you'd had experience with single family. How did you land on multifamily as your area focus?
The truthful answer is on accident. I was trying to figure out how to scale single family. And I remember I was deployed. I was somewhere in the Middle East on a big body of water on a Navy ship somewhere. And we didn't have great Wi-Fi. We didn't have any Wi-Fi, actually. We couldn't get to regular websites or anything like that. And so every time we got off the ship, I'd open up my phone, I'd go to Amazon, and I would buy real estate books. I was focusing on single family, and I accidentally downloaded a book on apartments. And that was it. I get through all of the books on my Kindle, and I'm sitting there with another week or two before the next port call. And I'm like, I guess I'll just read this book on apartments. That's really what kind of started me thinking about it. Is up until then, I had never really looked at apartments as something that I could do. It always seemed too hard or just out of my reach. And I knew I could do single family because I had done several before. Well, 3, I guess not several, but I knew I could figure out how to buy a single family house because I had done it before. So once I did that, once I read that book, it got the wheels spinning. And so I bought another couple of books, downloaded on my Kindle at the time, and started reading those. And once that deployment was over, I just started binge listening to podcasts, and then eventually got into a coaching program. So that was kind of like my ramp up and my transition. It was a slow transition. I mean, that deployment started in late 2016, ended in 2017. And so it was a full year before I really was committed to it and decided to jump in.
Yeah, I mean, obviously, you've got other priorities than reading and digging into multifamily real estate. I want to unpack your multifamily journey a little bit more. But before we do that, I'm going to take a quick sponsor break. So we will be right back.
Whether you're trying to hire a full-time employee or a contractor to fill a gap, Hire Tomorrow can help. Hire Tomorrow is a boutique recruitment firm that has successfully filled sales and marketing, human resources, and technology positions with companies ranging from startups to Fortune 500. If you're struggling to find the right talent, check out HireTomorrow.com or reach out to recruiting at hiretomorrow.com to see how they can help.
All right, we are back on the Work Hard, Invest Harder podcast. We've got Brian Briscoe on the pod. So you're on a ship in the middle of somewhere that you can't tell me unless you get to kill me. And so, and you're learning about multifamily accidentally. So let's kind of fast forward a little bit and you get back to the US. You're kind of probably buzzing on, multifamily and really wanting to kind of put some of the lessons that you learned into action. And obviously it sounds like you joined a mentorship group. How did you pick a mentorship group? Because I did that as well. Like my journey kind of started in 2019, buying a duplex. And then I quit my full-time job to go full into real estate in 2020, which was poor timing to start. But I kind of did what you did. I drank the Kool-Aid. I listened to podcasts, followed everybody on Instagram and all that stuff. And I guess, how did you pick? Because there's 1,000,001 gurus out there that have their own mentorship programs. So what was your kind of criteria that you looked for? Because I've talked to a lot of people and they don't know what to pick because there's so many options out there and everybody looks like they're Grant Cardone on Instagram.
Yeah, I wish I had a better story than this, but it was the Michael Blanc one. And I was moving from San Diego to DC. And on one of his podcast episodes, he mentioned he lived in Northern Virginia. And I think at the time, I only knew of like 2 different people that were taking on coaching clients. And so I went to one of his events and it was close to home. And I'm just like, well, I mean, the other guy that I know that does events, they always do them somewhere else. So I won't have to buy plane tickets. That was really it. I didn't do a whole lot of due diligence into which would be best for me. But I mean, it turns out it worked. I think what I've realized with mentorship programs since is it's not so much the guru, but it's the person that matters most. So I was in there, I was ready to learn. I soaked everything up like a sponge and I immediately put it into action. I think that was the secret. It wasn't, did I pick the right program? It was more of the, am I the right person for the program I picked?
No, I think that makes a lot of sense because I've known a lot of people that have been in mentorship programs and they maybe wasn't the right timing, right? Because obviously you need to kind of make sure that your timing is right because you're going to learn something from any guru you go to, right? It's just a matter of, are you in the right headspace and you have the right mentality kind of absorb and then to your point, put into action the teachings, right? So I think you kind of said it well in the way that it doesn't matter necessarily the program, you've got to be in the right space to absorb and take action on what's being taught. I'm familiar with Michael Blanc. I actually looked at his program when I was kind of looking at my own. And correct me if I'm wrong, but he focuses more on smaller deals initially, under 100 units. And then as you kind of get your feet wet as a mentor or mentee, I guess, then you kind of scale up to some of the larger stuff. Is that kind of how it worked for you? Like, did you jump in with kind of the smaller deal flow or deal sizes?
I don't know if he taught that specifically, but that's what we ended up doing. So my first property, when we talk about purchase prices, it's I wish we could still buy stuff at that level, but 55 units, we bought it for $4 million, right? And so it was a decent sized property and it was a reachable purchase price, $4 million with 4 guys trying to raise money for it. So we were able to do the capital raise and get that taken care of. But that was our idea, is we start with something reasonable. And we slowly grow from there and get into larger and larger properties.
One of the things that I always had trouble with when underwriting deals like under 100 units or maybe even under 80 units is just the property management, right? And so the magic number is kind of like 80-ish units where it makes financial sense to have on-site, one person on-site for maintenance and one person full-time on-site for leasing. So 55 is obviously under that threshold. So how did you guys underwrite? How did you think about property management? How did that all work?
Yeah, well, at the time, we didn't really think about property management because we were brand new to the game. But actually, I was a couple minutes late logging on because of property management call. But yeah, you're right. There's an interesting space where it's harder to manage. I'd say 20 to 60, 20 to 80 is kind of that space where it's large enough where you need a little bit more attention on the property. I mean, single family homes, you don't need somebody there every day managing it. But so when you get to 20 to 80, 80 is about that break-even point where it makes financial sense to have management. But so I've ended up owning a lot of properties in that 20 to 80 unit space. And so it is a challenge to get the management taken care of. I think there's a couple of ways to do it. Number one, when we've gotten third-party property management on everything, but we want to make sure that the property management company is actually close to the asset. We've had a couple of assets that we piled onto a property management company, and they're 40, 60, 80 miles away, and those didn't get a whole lot of attention. So for the offsite, we want to make sure the property management company is actually close enough where getting out to our property is not going to be a pain in the butt. We try to do is cluster things.
Yeah.
We can get a cluster of properties together. So at one point, we owned a 80 unit right next to a 40 unit. We bought both of them pretty close together. I mean, we bought the 80 unit and then saw that 40 unit pop up and like, yeah, we can do that one too.
Yeah.
So there's a lot of cases where we bought some of the smaller properties knowing that we could dual site management. But yeah, upfront management was just like something that I don't think anybody thinks about on their first property because people just don't know what it's going to take. But that's also been one of our biggest challenges as well, is to right size management and find management companies that are good fits for the property type and for how we're conducting business as well.
No, and property management seems like definitely the problem area or the area of opportunity, I guess, for or differentiation point for a syndicator, right? I've talked to a few people that over the last kind of just 2 years, they've decided to take the plunge and bring property management in-house and essentially hiring full-time staff. That's really the only way to make sure that you can control kind of the culture, the focus, and all of that at a property, because property management staff turnover a lot, especially on site, and maintenance staff is very difficult to find and staff and everything. So yeah, I'm sure you've kind of gone through the ringer, if you will, on multiple property management.
Yeah, we're actually transitioning property management companies on one of the projects that we purchased 6 months ago. 6 months in, and we're already moving on. It is unfortunate, but I'm very reluctant to move property management services because we found out in retrospect that some of the companies that we fired weren't actually that bad. When you go to a company that's worse and you're just like, man, can I go back? There have been a couple of times. Incidentally, my portfolio, I've started out in South Carolina and Georgia, but I've had properties in Texas, in Ohio, and now in Oklahoma, and Salt Lake is my current focus. But a lot of these smaller property management companies that will manage these smaller properties, they're not national. So we've had a couple of cases where we're looking with a regional property management company and we fire them because we don't like how long it takes them to turn units, where it's like 30 days on unit turns and you're like, guys, you're killing me.
Yeah.
You know, and you go to the next property management company and they're bad at unit turns and collecting. You're just like, oh crap, come on. So we have had to kind of play the field. But what I've learned is somebody that does a decent job managing, I think that's okay. And we just learn where to pick up the slack. So if they're terrible at turning units, that's where we put a little bit more horsepower in. And maybe we're handling that part. If it's going to be a renovation, we're scheduling the contractors instead of them. So it really ends up being more of this is what they're good at. This is what we can let them do without worrying about it. And these are things they're not so good at. So these are the things that we're keeping control of ourselves.
Yeah. One thing I've realized over the last probably 2 years that's been very apparent are properties that have poor asset management. So kind of the people that are on the general partnership team that are not paying as close of attention to what the property managers are doing to execute the business plan. So you've obviously lived through this. And I guess before I ask this question, like, what's your strategy? Is it a value add strategy where you're buying deals on variable rate debt and bridge loans and all of that? Like, is that kind of your philosophy as kind of a standard syndicator?
Well, fortunately, the variable rate debt is something that we did not do a whole lot of. So out of 18 properties that I've syndicated, I've had 2 variable rate loans.
Wow.
And one of them was after the rate hike cycle had really finished. So it was like, rates aren't going up anymore. We might as well get the variable rate. But yeah, we do like the value adds. We were fortunate to have a couple of local lenders on a lot of our properties that we purchased in 2019 and 20. But like local credit unions, local banks that gave us bridge type products, meaning, higher leverage. And really, I think what most people are looking for with those bridge products is to fund a lot of the renovations.
Right.
But we were able to find some banks or credit unions that would fund the renovations and give us a fixed interest rate in return. So I do like the idea of value add, but as the years have passed, I think I like the idea of buying good properties and holding on to them a lot better than the quick flips.
Yeah.
And I mean, to be honest, as a syndicator, it's really easy to flip things, especially when the market's going great. But what I mean by it's easy to flip things is you go in, you do the work, and you sell it. You don't have to learn how to manage. You don't have to learn how to do anything besides fix things up and put heads in beds, and then you turn it over to the next person. But the other reason it's really easy is because you get paid when you buy and you get paid when you sell. And so I think the allure for a lot of the syndicators with that value add model is it's quick. It's a quick payday on the front end. It's a quick payday on the back end. And you don't have to do the hard part of managing. But the more I look into it, the more I realize that, especially now, we're seeing a lot of people who had those bridge loans. I mean, we're buying a property right now from somebody who's going to lose almost $1 million. And we bought a property a couple months ago. The property manager that I was just talking with knows these guys very well. And we were just talking about them. He's like, yeah, they were in some real serious trouble on property. So when you start looking at how to not lose with real estate, I think the answer is you get that fixed rate loan and you hold it for a long time. You find a good property. If it needs a value add, awesome. Get in there and add value to it. But right now I'm leaning more towards let's just find good properties in good locations. My acquisitions guy this at least 100 times. The first thing to do when you look at a property is just look at it and say, do I want to own that property 20 years from now?
Yeah.
And if the answer is no, we're not even going to take a second look at it. That's really the philosophy now. And so, out of the last couple of acquisitions, we bought a couple of stabilized properties. We bought a couple of value adds, and we'll continue to do whatever makes sense. So something that we can own for 10 years that we'll be proud to own for 10 years and take advantage of time.
And are you selling to your investors that, maybe not selling, are you explaining to your investors that your time horizon is longer than a typical syndication, right? Because most syndicators, even back in when they bought deals in 2019 and flipped them in 2021, made a bunch of money, that's when things were easy, right? We're realizing now that you actually have to operate these properties because with interest rates going up, obviously valuations are not going up, in most cases going down. But most syndicators are touting or explaining to investors like, hey, we're a 5-year kind of turn kind of model. If I'm an investor in one of your deals, is it more of like hey, this is a long-term play where we're focused on kind of steady cash flow and the appreciation will come, but it's really a 10-year-ish horizon versus a 5-year?
Yeah, we like the 10-year horizon. And our basic model is we're going to try to refinance out somewhere in that 3 to 5 year range. And on the value adds, that refinance can probably come a little bit quicker. But the idea is we kind of give our investors the best of both worlds. With the value add syndications, the really nice part is they're in and then they're out. But there's a lot of risk. And so what we try to explain to people is there's a lot less risk in what we're doing. The returns might not be as high. I mean, we had I think the best property that I've had full cycle, I think we gave 35% annualized returns, which is a decent number. I've seen people do a lot better than that, but that's still a really good number. I'm probably not going to hit 35% annual returns on anything, but we're not going to lose either. So we do come in with a little bit more equity. Our last acquisition, I think our loan to value was 56%. Okay. So a lot of the properties we're looking at buying, we're coming in low to mid 60s on our debt. So we're raising a little bit more money, which does dilute returns. But once again, it's a safer position. We're holding the property a little bit longer, which once again does lower the returns. So when you look at a deal from Brian Briscoe and Streamline Capital, you're going to look at that IRR number and you'll be like, why would I ever invest in this one? But the reality is we're coming in lower leverage and we're holding for a longer term. And those are the two things that really pump up that IRR number. But on the flip side, those are also the two things that create the most risk. And so the higher leverage deals do create more risk. So I like the idea of longer term holds, a little bit lower risk. Some investors look at that and say, well, this deal over here has got an 18% IRR. I don't know why I'd ever invest in anything that's advertising a 13, but the investors that understand it are happy to invest.
Well, I think it's also kind of you can think about it as a diversified portfolio strategy also, where maybe if you're an investor and you know that Brian's deals are going to be consistent. They may not be the big home runs that another syndicators are, but they're also going to be less, to your point, less risky because you have fixed rate debt, you're buying less leverage, and you can say, okay, yours is more of a traditional or a safer bet. And then I'm going to put some of my money into another deal that the higher risk, but potentially higher reward. And I think there's probably enough investors out there that will love your deals.
Mm-hmm.
And there's other investors that would not invest with you because they want the 2-3x returns in 2 to 3 years. And that's just, to your point, high risk, high reward. So
I think when you get into a different, like the higher level of investors, they've got money in several different pots. They've got a certain amount of money allocated to the higher risk, higher reward stuff. But a lot of the people with 8-figure balance sheets, they're allocating a large percent to things that are cooking, that are just simmering over time and going to keep on growing. And I mean, they'll have a little bit of money that they're playing with the higher risk, higher reward, maybe some venture capital over here, some angel investing. But when you start looking into the higher net worth investors, a lot of them are putting money into a lot of different buckets. And I'm very happy providing the bucket that I'm providing because we do get a fair amount of non-accredited investors that still jump into our deals. We do primarily 506Bs, but the people that can write the larger checks, a lot of them are looking at those deals as a little bit safer. We can hold them long term. We can park money here and not worry about it for 5 or 10 years.
I'm curious about, because it sounds like you have a lot of high net worth individuals in your kind of Rolodex, if you will. Why the 506B versus a 506C?
Because of where and how I grew up. I know none of my siblings are accredited. And my brother's going to be investing in my next deal. I've got a couple of brothers. And just looking at my family, none of my cousins are really well off. My grandparents weren't really well off. But just start looking at down the line, a lot of it is I want the opportunities to be open to regular people. So that's really what it is. Would we do better doing 506Cs and exclusively catering to the accredited investors? Probably. One thing that we're going to be doing here soon is, and the first time I've done it, is a 506B to C conversion where we started things out as a 506B and roll into a 506C, which kind of gives us the best of both worlds. We can still bring 35 or so non-accredited investors in to the deal and then flip a switch and roll into a 506C. So anyway, I think it's very personal why we do 506Bs. It's nothing to do with the business. And we can still raise the amount of money we're trying to hit. So it works.
I love it. I grew up in a small town. I was saying this kind of in the green room, and I wasn't accredited until a few years ago. And so I like that when I first started investing, I wasn't accredited. And so I was able to get into a few deals passively. And it is great to be able to offer an option to people that historically have thought about real estate investing outside of maybe single family for the rich and the famous, right? So all the deals that I've done have been 506Bs. And so I like the fact that, yes, you can't advertise, but if I have a substantive relationship with somebody, I can go to you and be like, hey, I got a deal. If you're at all interested, here's the kind of outline of what we're looking at. And I don't care how much, I do care, but it's not required for you to make a certain amount of money or have a certain net worth and all of that.
Yeah.
So I have the same philosophy. I like it. I think there's a time and place for a 506C if you're doing something maybe a lot bigger where you need to kind of advertise and get a bunch of big people. But also if you've got a good enough Rolodex, you can raise a lot of money. So that makes sense. You mentioned Salt Lake City. I do want to dig into that for a few minutes here. So it sounds like you've invested in deals and bought deals in multiple states and multiple parts of the country. Mm-hmm. And I guess why narrow in on Salt Lake?
It's still my favorite place. I mean, I grew up there and for the longest time I wanted to get out, but every time I come back to Salt Lake, and it's a beautiful city. There's a lot of good things happening there. Very recently starting to hit the top charts for growth. I think the Milken Institute ranks Salt Lake City as the number 4 metro for sustainable growth. When you look at the demographics, the economics of the Wasatch Front, which is the locals refer to as the greater Salt Lake area, there's a lot of growth there from the population. There's a lot of growth there in the economy. And it's just a beautiful city. It's a great place to live. It's still relatively low crime. I met a guy that recently moved from Atlanta to Salt Lake. And here's kind of a really really good indicative conversation is I was talking about asset classes, and I said, yeah, occasionally we'll get a C-class apartment. I'm really focused on B. And he looked at me and he said, are there any C-class apartments in Salt Lake? I'm like, yeah, there's a lot of C-class apartments. I didn't realize what he was saying at first.
Yeah.
I'm like, yeah, there's a lot of C-class apartments here. Like about half of them are C-class. And he's like, I'm from Atlanta, and the C-class here don't look anything like the C-class in Atlanta. So when you start looking at quality of life and everything else, I think Utah really has that nailed. So from many different perspectives, potential future growth, there's a lot of entrepreneurship happening, a lot of tech startups. You've got some big families that are trying to bring big sports teams in. So they're trying to get Major League Baseball. They're trying to get National Hockey League franchise. So there's a lot of growth there. Yeah.
I went skiing in Salt Lake City 2 years ago, I think it was, maybe 3. And obviously flew into Salt Lake and all that stuff. And it was my first time skiing out west. I grew up in Pennsylvania and skied in Vermont and things like that, but never out west. And that was a different experience, seeing how big the mountains and everything are. And it's interesting. And so are you investing kind of in the kind of the Salt Lake City kind of metro, or are there suburbs that you're kind of looking at that are kind of path of progress that you're also looking at deal flow in?
Yeah, I do like the Salt Lake Metro. And when you talk Salt Lake, I mean, Wasatch Front's probably a better way to say it. That's the mountain range that you went skiing in. It was the Wasatch Mountains. And most of the population is right along the base of those mountains. And so Salt Lake City is kind of like right in the middle area, and there's a big valley there. And then the valley closes off at the top, and you go up north into like I think technically it's the Ogden Clearfield MSA, and then to the south where the valley closes off, you get into the next valley. That's like the Provo-Orem MSA. But
got it.
So we refer to that all as the Wasatch Front, all that populated area right along the Wasatch Mountains. But I mean, Salt Lake is kind of like has always been where the economy was focused, where it was the big city, but that's starting to change now, where I think Utah County is starting to pick up. They're starting to grow faster. They're starting to get a lot of tech companies there. The area referred to as Silicon Slopes, kind of a play on Silicon Valley, is largely in Utah County, which is just to the south of Salt Lake County. So I think we're seeing a little bit of a shift. And I think in the next 5 to 10 years, we're going to see kind of that area emerge as like the second hub. Right now, Salt Lake really has the only big downtown area in Utah. And I think we're going to see Utah County kind of grow. And a lot of the population estimates say that Utah County is actually going to surpass Salt Lake County in 5 to 10 years. And I mean, Salt Lake has really just kind of filled up the valley, and Utah County's got a lot more open land. So I think if Salt Lake County weren't constrained, it has mountains on both sides, basically a circle of mountains with the Great Salt Lake to the northwest. But I think if Salt Lake had more room to grow, it would continue to grow. But yeah, a lot of the growth right now, like I said, is Utah County. So if you're looking for path of progress, there's a couple things that are happening. There's a lot of like new developments and new land stuff going on, but we buy existing properties. And I think when you're buying the existing properties, we tend to focus on the areas where there's in single family house terms, where there's a lot of flippers, where a lot of people are going in and flipping. South of Salt Lake City, specifically South Salt Lake and southern part of Salt Lake City proper, there's a lot of new developments going in. There's a lot of buildings that are being knocked down and bigger, nicer buildings being built in their place. And so when you look at path of progress, that's what I like to see, especially if we're doing a value add, especially if we're doing a long-term hold. I want to know that that area is going to be better than it is right now when we try to sell it in 10 years. So we're looking specifically for path of progress stuff. We're looking specifically for areas where 10 years from now, the area is going to be as good or better than it is now. And I mean, I think if we hit those metrics, I mean, we can't lose.
Yeah, it's one of the things, if you buy it right, if you don't overextend, if you know what your buy box is and you stay in that buy box, I think that's where some of the deals that I'm in, frankly, we overextended, right? You kind of wanted to get into the deal flow and get deals in 2021, and you maybe thought rents were going to go up faster, or you thought values were going to stay where they were or grow. And so if you can be disciplined in this game, and it sounds like you are very disciplined, like that's the type of person that you want to invest with, in my opinion, because you're not going to chase a deal. You're going to find the deals that work for you and buy those and not buy anything else. I think I know the answer to this, but I'll ask it anyway as we kind of get to the end here. Like 2024, we're recording this in mid-March. What's your kind of outlook on the multifamily real estate space? Obviously, it sounds like you're still actively buying and looking at deals, but give me your kind of broader market outlook for this year.
Yeah, I mean, I think inflation numbers were released last week and they weren't as good as everybody was hoping. So what I'm seeing, most people right now are saying the Fed's not going to lower interest rates until June. They meet next week and everyone's expecting them to keep things where it's at. They meet again in May and probably a coin toss. But I think when we look at the bigger scheme, the bigger market cycles, I think we're pretty close to the bottom right now. If we're not at the bottom, we're probably close enough where we could reach out and touch it. So whether we're coming back up from the bottom or we're still got a little more to slide, that's where I think we are in the economy. So, well, multifamily specifically, I think every different asset class has like a different part of their cycles are different. But so for 2024, I want to keep on buying. And I was able to close on several properties in 2023 and it's March. And I think by mid-year, we'll have a couple acquisitions under our belt. But we're not forcing things where we're trying to buy good properties in good locations. And I think just where we are in the economic cycle, it's a good time to buy. It's a good time to lock in your basis. We are being very flexible on our debt, trying to get debt that doesn't have like significant prepayment penalties. So if the rates come tumbling down like everyone thinks they should, or they will, we'll be able to pivot out of our debt and keep a property with a low basis.
Yeah, no, I think it makes sense. So I want to transition to kind of the final three questions as I've captured a lot of your time. So I appreciate that. So first question is, what is one piece of advice that got you started or helped you on your real estate journey?
It was somebody, retired Air Force guy. And I remember his story kind of paralleled mine, where he was working at the Pentagon trying to do real estate on nights and weekends. I remember I told him I was looking to buy like a 5-plex and he put his hand on my shoulder and says, yeah, you could do that, but you might as well syndicate, learn how to raise money and start big. So it's my boy, by the way, 11 years old.
I like it.
Home from school.
Welcome to the podcast. Question 2 here. Sounds like you're an avid reader and have been for a while. What is your favorite real estate book or business book that you're into right now?
Traction. By Gino Wickman. It's definitely the business book, not the real estate book.
Yeah.
You know, it's one of the things that the first company that I co-founded ended up leaving. I mean, we didn't have a lot of internal structure and procedures built. And Traction is basically a guidebook for setting up how your business runs. So that's it. That's the one that I constantly open and refer to. And that's the one that we're using day in, day out.
Have you guys fully implemented the EOS model?
Mm-hmm. Yep.
Yeah, I actually read that book in Aruba in December. And I always take a business book when I go on vacation if I'm going to lay on the beach, because I like at least read a little bit while I'm there. And I literally was taking notes and writing things because as I'm scaling I've got a recruiting business. That's my other thing. And yeah, it was super fascinating. I was like just literally taking notes kind of on the fly. So it was great. Yeah.
We have an EOS implementer and I talk with him almost on a weekly basis.
Yeah, no, that's awesome. Final question here. If you hit your financial freedom number, meaning you can live an amazing life just off of the passive income from your investments, what would you do?
That's a good question. I would spend a lot of time with family, people and causes. I think one thing that we've started doing is, and I want to start doing more of, is just celebrating as family together. More vacations, more time together. I want to get to the point to where we can have big epic vacations every year, where couple times a year where the entire family gets together. And I think a lot of it's just going to be good causes and spending time with people that are close.
Yeah, no, I like that. I like that a lot. So Brian, this is awesome. It was really great to learn about your story and I appreciate you sharing your insights and everything. If people want to learn more about you, obviously you've got your own podcast, Diary of an Apartment Investor. Obviously go check that out. What's the best way to catch you?
LinkedIn, by far. I spend a lot of time on LinkedIn every single day, and I post 4 or 5 times a week. So if you want to just listen or read what I put, LinkedIn's the best place. You want to reach out to me, I mean, that's probably the best place to do it as well. So connect with me on LinkedIn. If you got questions, DM me. If you don't have questions, just interact with the posts and eventually reach out to me when you're ready.
Yeah, no, I think that's how we got connected. I definitely been following you on LinkedIn, so I appreciate the content that you put out. So Brian, this is awesome. I really appreciate the time and you sharing your story.
Awesome.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast. Your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please like and comment. I read every comment as it helps me serve you better. Make sure to subscribe and hit the notification bell. That way, you won't miss out on more valuable content. If you're watching this video, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.